Cash once whispered freedom, folded quietly in wallets, pockets, and envelopes beyond institutional memory. It asked no questions, kept no logs, and left no trail for auditors, algorithms, or distant committees. For centuries, cash was privacy made portable, value carried without permission or surveillance. Today, that silence is treated as a threat rather than a right worth defending. Governments say cash enables crime, corruption, tax evasion, terrorism, and the darkest economies underground. Banks say cash is inefficient, expensive to handle, risky to transport, and obsolete in digital markets. Tech companies say frictionless payments create inclusion, convenience, and innovation for modern societies. Each argument sounds reasonable alone, yet together they form something colder than progress. Because cash is not just a payment method, it is a boundary between the individual and the system, tracking behavior, spending, movement, and intent. Every digital transaction creates a record, timestamp, location, counterparty, and behavioral fingerprint. Cash creates none, and that absence terrifies systems built on total visibility. The war on cash did not begin loudly with bans or speeches. It began softly with convenience, apps, rewards, and subtle nudges toward plastic and phones. Tap here, scan to earn points, get cash back, skip lines, feel modern. Choice slowly narrowed until cashless preferred became cashless only in everyday spaces. In Sweden, cash usage collapsed not through prohibition, but social pressure and banking design. In China, mobile payments replaced wallets within years, embedding identity directly into commerce. In India, demonetization overnight transformed cash holders into suspects without trial or appeal. Across Europe, withdrawal limits quietly appeared, framed as safety rather than control. Every step followed the same logic: reduce anonymity to increase compliance and manageability. Cash makes enforcement expensive, delayed, and imperfect, which frustrates centralized power. Digital money allows instant freezes, reversals, restrictions, and behavioral conditioning. At scale, control becomes programmable, precise, and invisible, enforced by code rather than police. Banks learned a dangerous lesson during financial crises and deposit panics. When withdrawals accelerate, liquidity vanishes faster than explanations can be printed. Cash empowers exits. Digital balances can be paused, capped, or rationed remotely. From the system's perspective, immobile money is stable money. This is why negative interest rates require killing cash first. If people can hold paper, they escape penalties imposed on digital balances. Cash creates a zero-interest floor governments cannot push below. Remove cash, and money becomes fully steerable by policy. Central banks now openly discuss central bank digital currencies as the future. CBSES promised safety, efficiency, inclusion, and resilience during crises and disasters. But they also promised traceability, conditional spending, programmable restrictions, and real-time oversight. Every unit becomes a policy instrument rather than a neutral store of value. With programmable money, taxes can be collected instantly at transaction points. Stimulus can expire if not spent fast enough in approved categories. Fines, sanctions, and penalties can execute automatically without intermediaries or delays. Economic behavior becomes adjustable like software settings, not voluntary human choice. Supporters argue law-abiding citizens have nothing to fear from transparency. History shows this argument collapses when definitions of law-abiding suddenly change. Emergency powers expand fastest during crises, then rarely fully retreat afterward. Tools built for safety become normalized instruments of quiet coercion. Cash allows dissenters, minorities, and marginalized groups economic breathing room. It enables survival when systems exclude, glitch, discriminate, or retaliate silently. During protests, strikes, or political instability, cash keeps life functioning locally. Digital shutdowns turn daily survival into a permission-based activity. The disappearance of cash is not about technology alone. It is about who controls access, conditions, and continuity of economic life. When money requires authorization, citizenship becomes a subscription, not a right. And subscriptions can be paused. This war is framed as modernization, but its consequences are structural. Once anonymity is gone, it never returns by accident. Once cash infrastructure disappears, rebuilding it becomes politically impossible. The door closes quietly, then locks. If cash is disappearing, the real question is who benefits from its quiet execution. Because every system change creates winners first, losers later, and silence in between. Digital money does not remove power. It concentrates it into fewer hands. And concentration always reveals itself during stress, not during calm marketing campaigns. The biggest winners are states managing debt-heavy economies under permanent fiscal strain. Tracking every transaction improves tax collection without raising visible rates or political backlash. Compliance becomes automated, not negotiated, enforced through infrastructure rather than debate. Revenue becomes predictable when money cannot hide or delay its surrender. Banks also gain leverage when deposits cannot physically leave the system. Digital balances stay captive, usable for lending, collateral, and liquidity engineering. Withdrawal limits transform panic into patience, enforced by apps and policies. Runs become theoretical risks rather than physical stampedes toward branches. Payment networks and fintech platforms gain data more valuable than transaction fees. Spending patterns reveal habits, beliefs, vulnerabilities, and behavioral triggers. That data trains algorithms, pricing, credit, insurance, employment, and access. Your money trail becomes your shadow profile, quietly scoring your economic trustworthiness. Corporations benefit when cash alternatives funnel spending through controlled ecosystems. Closed-loop payments enable dynamic pricing, behavioral nudges, and loyalty conditioning. Spending becomes steerable toward preferred partners, products, and compliant consumers. Choice exists, but only inside curated lanes, invisible to most users. The losers appear later, often framed as edge cases or unfortunate necessities. Small businesses lose bargaining power when every sale passes through monitored rails. Margins shrink under fees, delays, chargebacks, and opaque compliance requirements. Cash once offered resilience. Digital dependency offers fragility disguised as efficiency. Workers lose leverage when income, spending, and savings merge into traceable streams. Strikes become harder when funds freeze or benefits require behavioral compliance. Gig platforms can throttle access without firing, using algorithms instead of managers. Economic pressure becomes personalized, quiet, and difficult to legally challenge. The poor suffer earliest and hardest during cashless transitions. They rely on cash to budget, survive shocks, and avoid predatory fees. Digital systems penalize mistakes instantly: overdrafts, lockouts, verification failures. What was once informal flexibility becomes formal exclusion enforced by code. Political dissent becomes economically risky when money carries identity by default. Accounts can be flagged, frozen, or limited without courtroom drama. Participation in protests, donations, or controversial causes leaves permanent records. Fear replaces resistance when survival depends on uninterrupted digital permission. History shows money control always expands during emergencies. War, pandemics, financial crises justify temporary measures framed as protection. Those measures rarely fully unwind once danger passes. Instead, they normalize as necessary infrastructure for future stability. Cash removal pairs perfectly with social credit and behavioral scoring systems. When spending reveals character, access becomes conditional on perceived trustworthiness. Punishment no longer requires imprisonment, only exclusion from economic participation. A locked wallet replaces locked doors. The argument that criminals use cash ignores scale and selectivity. Major financial crimes overwhelmingly occur through regulated banking channels. Fines replace prison for institutions. Surveillance targets individuals instead. Cash becomes scapegoat for failures of enforcement elsewhere. The truth is simpler and more uncomfortable. Anonymous money limits power, slows control, and preserves individual optionality. Systems seeking efficiency and predictability view that as inefficiency and risk. So cash must disappear quietly before resistance organizes. What replaces cash will not arrive as a single switch. It will arrive as layers, limits, friction, ease, discouragement, then absence. ATMs vanish, branches close, exact change unavailable, signs multiply. Choice disappears long before laws officially confirm its death. The end state is not a dystopian movie scene. It is a smooth interface where access feels normal until revoked. No alarms, no soldiers, just a message saying temporarily unavailable, and no alternative left standing. Understanding this is not paranoia. It is historical pattern recognition. Every expansion of monetary control followed promises of safety and progress. Every time, reversals required extraordinary political upheaval. Rights surrendered quietly are rarely returned politely. The purpose of this story is not panic, but awareness. Awareness creates preparation, diversification, and resistance to single-point dependency. Cash's death is not inevitable, but its survival requires conscious defense. Silence accelerates outcomes designed to arrive unnoticed. If this story gave you a new way to see history, subscribe.